Welcome to another episode of
Monday Mortgage Minute.
Okay, thanks for joining us for another episode of Monday Mortgage Minute. I'm Kymm for Homes, your resource for all things real estate here in Southern California. And of course, we have our amazing lending partner, Liz, with Gautanreed Rate Affinity. Okay, Liz, we have a question that came in. Yes. So the question that we have is there's so many more buyers that are coming into the market. I know you're seeing it. And a lot more approvals that are getting issued. But one question that this particular viewer had was, once approved, they were approved for both the option of having an adjustable rate mortgage or a fixed rate mortgage.
Okay.
And the question was, what is the difference and which is the better option that a buyer should go with, especially a first-time home buyer? What do you think?
Well, that's a good question. I mean, it really, I guess, depends on the buyer. So the difference between a 30-year fix and an ARM product, just what it sounds like. It's an ARM loan, meaning it's not a fix.
ARM being an adjustable rate mortgage.
Correct.
Okay.
So depending on the term that you get, there's different types of ARM products or adjustable mortgages, such as a 3-year, a 5-year, a 7-year, or a 10-year term, meaning the rate would be fixed for that term period, and after that it becomes adjustable. And the way that's adjusted at that time would be the lender will set a margin from the very beginning. Depending on where the index is when the time is due to adjust, that rate can either go up or down. Now, there is normally a cap as to how much it can increase or decrease every time that it does adjust, and that's also set from the very beginning. So that is definitely something to pay attention to. Pros and cons, adjustable to a fix. Normally on an adjustable mortgage, you'll see the interest rate a little bit lower than it would be on a 30-year fix. So you do get to save some money. And then obviously the con would be that after a certain period of time, it does become adjustable. But it does give you enough time that, let's say if you did decide to do an ARM product because you want to save some money and it's a 7-year term, then within those 7 years, you do have an option to refinance. You're not tied to that loan for the next 7 years. There's no prepayment penalty. So even within the next year or 2 years, you have an opportunity to refinance and get you into a 30-year fixed mortgage, then you should definitely take advantage of that.
That's awesome, because that's one thing that I don't think people realize. You can refinance out of any of these loans. You know, it's a matter of, is there a prepayment penalty? So you want to make sure that you kind of weigh the pros and cons at the time that you're ready to refinance. But the fact that you can refinance out of something, so you can get in lower at a lower rate and get that payment going for a while, and then if you see that we're starting to ease up, you can refinance the current market value. Or if you see that rates go down, you can go ahead and refinance to a lower rate.
Yeah.
So that kind of doesn't have a lose unless you are just depending on it staying at that rate. And that's not the case. But with the fix, you know what your payment's going to be for the next 30 years. And again, you can refinance out of that if rates drop. So there's lots and lots of options. Now, I just want to bring up, now this is totally different than, say, a rate buy down, correct? With the rate buy down, let me make sure I understand it, because this is how I've explained it, so correct me if I'm totally wrong. Because with the rate buy down, we're going to get that lower rate that is negotiated for a fixed amount of time, 1, 2, 3 years. And then at the end of that period, it's already established at what that rate is going to then go to. So you know what that worst case scenario is up front.
Right. So we're talking about, let's say, a temporary buy down. A temporary buy down, let's say if today's interest rate was at 7.5, there's different types of buy downs. There's a 2-1 buy down, there's a 1-0 buy down. So let's say, for example, on a 2-1 buy down, if today's rate was at 7%, you can start as low as a 5% the first year, a 6% the second year, and then you'd end up at 7%. But within those 2 years, obviously you have an opportunity to refinance, and at that point you can refinance as well. On a 1 year, if today's rate was at 7%, then you would start as low as a 6% the first year. So for anyone that's looking to buy, especially on the first year, you're trying to get comfortable with that payment, or maybe you're buying a house that needs a little bit of work, this gives you an opportunity to save some money in regards to your mortgage payment, and then you can, have that extra, either getting used to the mortgage payment or having some extra money to fix that place. Now keep in mind though, on a temporary buy down or one of these buy down programs, it does need to come either from a seller credit, where the seller is going to give you a credit to help you with this buy down, or you can also do it with a lender credit. A lot of the times what I've been doing, especially on a 1-0 buy down, I can offer a lender credit to help with that interest rate the first year.
And then we, as your realtors, we go and negotiate with the seller to get a credit, so that credit would actually pay for the buy down, because you as the buyer cannot pay the lender for this buy down. It has to come from an outside source, either the seller or the lender. And that combination can really give you a really good entry into your homeownership and kind of ease you in to this new payment. Because in some cases, it might be a little bit more than what you were paying for your rent, but at the end of it all, it ends up saving you a lot of money with your tax benefits, with the equity that you're earning. It goes on and on and on. But this kind of gets you eased into that. But the best part, all of it, you can refinance into new options at any point in time as you see the market adjust.
For sure.
So this is really great information. I hope that we are completely answering your question for the viewer that viewed in and sent this question. But if not, you can always send a follow-up, and anyone else that has a question, anything regarding real estate, lending, we are your resource. So send us your questions. We'll be happy to help you. This process can be a little bit stressful, a little bit confusing, and a lot of information, and that is why we're here. So thank you for joining us for this week's episode of
Magic Mortgage Minute.
And tune in next week and drop your questions. We're here to help.